back to JPX Energy Market Weekly Updates. During the past week, oil prices continued climbing due to bullish outlook and tensions between Russia and Ukraine. This figure shows the number of daily infections continue to rise. The number may sound concerning, but some experts are cautiously optimistic that we could be getting closer to herd immunity. As the world learns to live with COVID, market anticipated travel bans will continue to be lifted in the near future. In terms of geopolitical situation, although Libya protection is about to resume, Russian military drills on the Ukraine border sparks commodity prices fears again. Libyan oil output, meanwhile, is poised to recover to about 1.2 million barrels per day after State-owned National Oil Corp reached an agreement with the petroleum facility guards, paving the reopening of the oil fields of Sharara and several other nearby, and the 300,000 barrels per day of Zawaya oil terminal. Russia and Ukraine tensions are at the forefront geopolitically, and they have potential to exacerbate European and global energy prices. Tensions would persist even if near-term talks prevented military action, with Russia escalation around Donbas and cyber attacks potentially achieving Russian aims by dividing the US and the EU on how forcefully to respond. Russian military exercise on Ukraine's border on January 14th have again raised concerns of a possible invasion of the gas and crude oil transit hub. According to EIA's analysis, numerous countries receive Russia's natural gas partly or exclusively through Ukraine. In the past, disputes between Russia and Ukraine over natural gas supplies, prices, and debts have resulted in interruptions to Russia's natural gas export to Ukraine. According to Plus data, Russia's gas transport through Ukraine has been declining in recent years and collapsed at the start of this year. And GIE has reported the European gas storage facilities were only 49% full on January the 12th and saw an extraction of 2.28 billion cubic meters in the 3-day period at the start of last week. If the current rate of withdrawal is sustained, European reserve could be fully depleted by the end of winter delivery. Ukraine is also a transit country for Russia's crude oil exports, which travel through the southern branch of the Druzhba pipeline network. In 2020, approximately 25,000 barrels per day of Russia's crude traveled through Ukraine. The spread between JPX Dubai and IC Brent has slipped again during last week. Geopolitical situation we mentioned above is not the only reason that led to the weakening of the spread. Market sources said that some independent refineries in Shandong, China, have been recently told to cut production during January the 30th to February the 20th because of the Beijing Winter Olympics. The move will not only alter the import strategies of the independent refineries over the next couple of months, it will also add to the woes of the independent sector in which 5 refineries has already been granted crude oil import quotas in the first round of allocations at the start of this year. And what's more, Asia currently still lag behind Europe and the United States in terms of travel recovery when facing Omicron virality. In the context of the high oil prices, energy costs remain the top driver of inflation of the U.S. in 2021. Gasoline surged 50% and fuel oil costs jumped 41%, according to January the 12th data from the U.S. Bureau of Labor Statistics. Experts consider rising inflation one of the biggest market risks this year because runaway inflation could corrode asset values, limit buying power, and eat away at corporate margins. Inflation ratings from the U.S. came in within expectations last week, while Fed chairman maintained the view of policy normalization coming sooner rather than later to curb inflation. He had put across that the pullback in monetary support was to ensure the economic recovery remains on track for further gains in the labor market. While many markets, including stocks and Bitcoin, have come under pressure this year because of impending policy normalization, but considering the good prospects on a pure return basis, but it can also be a good hedge against possible growing market volatility. The net long positions in managed funds are likely to continue rising, and that could also help push up oil prices. However, EIA has forecasted that the crude oil prices this year will have some downward pressure in its latest monthly report. EIA forecast the Brent crude averaging 78.63 per barrel during the first quarter this year and will fall to 70.89 during the fourth quarter. Global oil production will outpace global oil consumption during both 2022 and 2023, resulting in rising global oil inventories. EIA expects global oil inventories will rise by an average of 0.5 million barrels per day in 2022 and by 0.6 million barrels per day in 2023. I believe the market volatility is going to be much higher in the period ahead, so a lower position is suggested. Okay, that's all for today. Welcome back next week.